Ever wondered how mutual funds work? Well, let's dive into it. Imagine a massive pot where people from all walks of life toss in their money. This pot is what we call a mutual fund, a type of investment vehicle. Now, what happens to this collected money? It doesn't just sit there. Instead, it gets actively invested in various assets like stocks, bonds, and other securities. But who decides where to invest? That's where a fund manager comes into play. This professional, backed by a team of analysts, uses their expertise to invest this pooled money according to the fund's objective, be it growth, income, or stability. The beauty of a mutual fund is that it allows you to own a slice of multiple assets, without needing to buy each one individually. This collection of varied assets that the fund holds is called a portfolio. And when you put your money into a mutual fund, you're essentially buying shares, or units of ownership, in this portfolio. So, in a nutshell, a mutual fund is a collective investment scheme that allows you to invest in a diversified portfolio. Now, let's delve into the structure of a mutual fund. A mutual fund is a sort of financial jigsaw puzzle made up of 4 key components. The first piece of the puzzle is investors. These are individuals who pool their money together to form the fund. The second piece is the fund manager. This is a professional who takes the pooled money and invests it according to the fund's objectives. Think of them as the architect of the puzzle. They decide where each piece goes to create the best possible picture. The third piece is the portfolio. This is the collection of various assets the fund holds. It can include a mix of stocks, bonds, and other securities, carefully selected by the fund manager. The final piece of our puzzle is shares. These are units that represent ownership in the fund. When investors contribute money to the fund, they're buying these shares. The value of these shares fluctuates based on the performance of the assets in the portfolio. So that's the basic structure of a mutual fund. Simple, right? Wondering how these mutual funds operate? Let's break it down. Firstly, the journey begins with you, the investor. You purchase shares of the mutual fund at a specific price known as the net asset value, or NAV. This is essentially the cost per share of the fund, calculated by dividing the total value of all the assets in the portfolio by the number of shares outstanding. Next, the fund manager steps into the picture. This individual is a professional who takes the pooled money and invests it according to the fund's objective. Whether the goal is growth, income, or a mix of the two, the fund manager aligns the portfolio to meet these objectives. Now here's where the magic happens. The fund earns money in 3 ways, through dividends, interest, or capital appreciation. Dividends are the portion of a company's earnings that are paid out to shareholders. Interest is generated from bonds and other debt instruments. Capital appreciation is the increase in the value of the assets held by the fund. After deducting any fees, these earnings are then distributed to you and the other investors in proportion to the number of shares you each hold. Finally, the NAV of the fund fluctuates. This is because the NAV is directly tied to the value of the underlying assets in the portfolio. As these assets increase or decrease in value, so too does the NAV. This change in the NAV reflects the overall performance of the mutual fund. It's important to remember that while this process might seem complex, it's all part of the mutual fund's operation. It's the fund manager's job to monitor the market, make informed decisions, and adjust the portfolio as needed to strive for the best possible returns. And that's how your money works for you in a mutual fund. So why should you consider investing in mutual funds? Here are a few benefits. First, there's diversification. Mutual funds allow you to spread your investment across a wide variety of assets, which can reduce risk. Think of it as not putting all your eggs in one basket. Secondly, mutual funds offer professional management. This means that experts in the field are making informed decisions about where to invest your money. This not only saves you time and effort, but also leverages their expertise to potentially enhance returns. Thirdly, mutual funds provide affordability. With a mutual fund, you can invest in a broad range of assets with a smaller amount of money than if you were to buy these assets individually. This makes the world of investing more accessible to many. Lastly, mutual funds offer liquidity. Depending on the type of fund, you can easily buy or sell your shares, providing quick access to your money. These benefits make mutual funds an attractive investment option for many. Just like shoes, mutual funds come in many types to fit different investment goals. To start, there are equity funds. These are the high-heel stilettos of the mutual fund world. Stylish, potentially high return, but come with a higher level of risk. They primarily invest in stocks. Next, we have debt funds. Think of them as your reliable running shoes, designed for comfort and stability. These funds invest mainly in bonds, providing a steady stream of income with lower risk. Then there are hybrid funds. They're like your versatile sneakers, a balance between style and comfort. These funds combine investments in both equity and debt, aiming to balance risk and return. Lastly, we have money market funds. Imagine them as your comfy slippers, safe and secure. They invest in very short-term, low-risk securities, focusing primarily on capital preservation rather than high returns. Each type of mutual fund offers its own blend of potential returns and risks, catering to a variety of investment appetites. Choosing the right type of fund depends on your personal investment goals and risk tolerance. Before you jump into investing, here are some key points to consider. First, investment objectives. It's crucial to align your personal financial goals with the objectives of the fund. Are you looking for growth, income, or a combination of both? Each fund has its own unique strategy, so choose the one that fits your objectives. Next, consider your risk tolerance. Different funds come with different risk levels. Equity funds, for instance, offer potentially higher returns but with higher risk, while debt funds provide a more stable income with lower risk. Make sure to choose a fund that matches your comfort with risk. Then, there's the expense ratio. This is the fee that the fund charges for managing your investment. A higher expense ratio can eat into your returns over time, so it's essential to factor this in when choosing a fund. Lastly, past performance. While it's not a crystal ball for future results, a fund's track record can provide valuable insights. Look at its performance over different time periods and in various market conditions. Always remember to do your homework before investing. It's your money after all. So there you have it. That's mutual funds in a nutshell. We've explored how these investment vehicles pool together money from multiple investors to purchase a variety of assets such as stocks, bonds, and other securities. Managed by professionals, these funds offer a way for individuals to diversify their investment portfolio and potentially earn returns through dividends, interest, or capital appreciation. Mutual funds come in different types, including equity funds, debt funds, hybrid funds, and money market funds, each with their own risk and return profiles. When considering investing in mutual funds, it's crucial to align the fund's objectives with your personal investment goals and risk tolerance. It's also important to understand the impact of management fees on your returns and to remember that past performance doesn't guarantee future results. Keep in mind that while mutual funds offer potential benefits, they also come with inherent risks, so always invest wisely and consider seeking personalized advice from a financial advisor. Remember, mutual funds are not risk-free, and investment decisions should be based on your individual circumstances and risk profile. Consider consulting a financial advisor for personalized guidance.